Good evening and welcome back to Be Rich. Today I want to talk about a strange paradox that is happening in the US markets. There are something which is not expected by many. America has a lot of ETFs. ETFs are basically exchange traded funds in which several compositions of stocks are put together. One such is called as quality stocks or quality ETFs. The point is that this kind of ETFs have high quality of companies. These companies have steady profits, low and steady growth, little or no debt, and these companies are expected to do well and make profits well into the future. But I have been always warning you that the prices of stocks would correct and would correct deep. But what was very surprising is the S&P 500 has lost only 20% of its money, 20% of its value this year, whereas these kind of good companies, ETFs, have fallen 25%. This has hurt a lot of investors because, after all, the principles of stock market is that companies such as Microsoft, Home Depot, Google, Meta, which have practically no debt and who are profitable and have steady growth, should do well. But what has happened is they have fallen at a rate much faster than the what the market has fallen. So in S&P 500 has lost 20%. A good companies ETF or what is called as a quality fund ETF has dropped 25%. Investors are perplexed and they don't know what to do. Why is this happening and what could be a possible reason? The answer is pretty simple and it is in twofold method. First, there is no particularly one way of measuring what is quality. Each mutual fund has a different way of metrics of finding what is quality, and it is left to the investor to choose the ETF with the appropriate measurement. One group of companies uses a measurement called profitability, where it divides profits by net worth and says what is the profitability of a company. Like this and so on, there are several definitions for what is called a quality company. These quality companies normally in the United States are of the bluest blue chips and they are not expected to correct. Why are these stocks correcting? Well, the these stocks are namely held by mutual fund managers, pension fund managers, and actually high net worth individuals. Most of these high net worth individuals who hold it through mutual funds and through directly on their books have been gambling all these years. The value of these high quality stocks keeps on increasing, and this has made them very confident of their ability to borrow against it. What they have done is they have used these stocks as pledge and borrowed huge sums of money at very or less interest or no interest from banks, depending upon their relationship, and flooded the PE space with liquidity. So what they had done, they have an underlying value stock or a value mutual fund. They pledge it with the financier, take money on low interest rates, and put it into startup funds. And this strategy has played extraordinarily well because their interest rate risk is negligible and can be easily serviced by them, and the value of the asset is continuously increasing. They don't lose much if the high tech few companies vanish or the startups don't do well. They are able to take long moonshot bets and make money. After all, what is now considered blue chip, that is Google and Amazon, were once upon a time startups. Therefore, they were looking for the next Google and the next Amazon from these startup companies, which is akin to looking for a needle among a haystack. and therefore they were running it well till inflation came along and put pressure on them. Their cost of money started to go up, and the value of these stocks they were holding came down, and they were forced to look for avenues to finance this mark-to-market loss. That is, I had X amount of money, I had given some stock as collateral. As the value of the stock goes down, either I have to top up the collateral or bring down the money. Normally, what happens is people sell what they have now and which has already made profits. This is human psychology. Nobody wants to sell a product which is at cost or a loss. This is the reason, as I represented once, a trader had both Infosys and BPL. He sold Infosys, retained BPL, and lost both monies. Thus, the ability of an investor to hold on to profit making companies in face of loss and fill that loss up with stocks from company in which he has badly lost money is limited. So to put good money behind bad money, they are forced to sell value stocks. They are forced to sell these quality stocks. These quality stocks like Amazon, Microsoft, Meta, and Abbott have done extremely well over the last 3-4 years and were the darlings of the quality mutual funds. However, what has now happened is when there is huge pressure in the market for liquidity, as it has been shown now, it is in America, as the Fed is not only increasing rates, at the same time indulging in monetary tightening. This means most investors are scrambling to sell some of their assets and make good the loans so that they are not forced to sell them in a distress. As I already explained, the psychology of these people, they rather sell assets in which they have made lot of money than sell assets which they have lost. And therefore, good level IT stocks and some pharma stocks have made lot of money over the years. And therefore, investors are willing to sell these stocks so that they can meet their margin requirements. This is the reason why Meta is down, but down by a huge percentage. In normal, what would have been a 20% 25% decline has reached a 50% decline. So has Abbott Laboratories, which is down 20%. Also, Google, which I recommended in this channel but told you to wait, has corrected more than 30% in this period. Therefore, when investors are in trouble, they sell the high quality stocks they own, putting pressure on the high quality funds, just accentuating the selling pressure in the market. Thank you for watching. Be Rich. If you like this video, hit the subscribe button, turn on the bell notification. If you do not turn on the bell notification, you will not be notified every time we put out a video. Once again, I thank you for your support for Be Rich. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.